Assalamu alaikum friends, welcome to IFRS 3, the last standard in your SBR. I have covered all the standards and now you will get all my standards starting from IAS 1 to IFRS 16 and also current issues. You will get it under my SBR lecture. The name of the playlist is SBR lectures. You will get all my lectures there and also the revision kit solutions. I didn't cover it yet. I will be uploading 2 videos every day. So the plan is to finish all the questions of the revision kit by 30th of August. Okay. So since IFRS 3 is very important standard because your question 1 depends on this, which is group accounting. And IFRS 3 is also a very long standard. Three to four chapters are there only on group accounting. So what I am doing is I will be making 3 parts of this IFRS 3. First part, I will be talking like this one is the first part. This will be talking about the definition of the business, when it's a business, what to do, when it's an asset, how to account for it, what are the definitions and all, and how do you know if it's a business or not? Because for theory part, you need this knowledge to write theory parts and all. Okay, how to define whether it's a business or an asset. Second part, I'll be discussing the IFRS 3 from the terms of group accounting. For example, you'll be consolidating, how to consolidate, how to find the NCI, how to find the goodwill, how to find the net asset, all those things. We'll be doing it in part 2, right? So part 2 will be lengthier than part 1 and part 3 will be focusing on the goodwill, impairment of goodwill. Impairment of goodwill, we have already covered impairment under IS 36, but this one will be specifically for the goodwill. Goodwill which we will be calculating after we buy a subsidiary. Okay, when that goodwill is impaired, how to calculate for that, because there are 2 ways that you can calculate goodwill. One is known as full goodwill method, one is known as partial goodwill method. So under this, what are the how the impairment changes, where it is recorded, all those things are a little different, so that's why it will be discussed in part 3. Okay, in addition to these 3 parts, there will be other videos especially on group accounting. For example, when you're doing step acquisition, you have bought 60%. Now you are buying additional 20%. You're not buying a subsidiary in one go. First you're buying 60%, he is your subsidiary. Now again you're buying 20%. So again he's a subsidiary only. It's known as step acquisition. What happens when you do the same? You are disposing now. Okay, and you're purchasing or disposing. It could be anything, associate, subsidiary, joint venture in the middle of the year, right? During the year, how to account for it? How to account for a foreign subsidiary? If it's a foreign subsidiary and you have to consolidate, there you need the rule of IS 21 also. And statement of cash flows I have already covered. Group statement of cash flows, where you have to deal with statement of cash flows when you're taking the subsidiary and the associates and all. So that is covered, but that is also there in the group accounting. Okay, so these are the things. Those will be the additional videos that I'll be covering after but definitely you'll be using the rule of IFRS 3 only for those things also, whether it's an overseas subsidiary, associate, joint venture, or a cash statement of cash flows, or step acquisition, disposal, all those things you need the rule of IFRS 3 only. Okay, that means if you're going through the textbook of Kaplan, it will be your chapter 18, 19 and 20, 3 chapters. All the 3 chapters are group accounting. In addition with this, chapter 21 also is a group accounting, which is statement of cash flows, but I've already covered IFRS IAS 7, so I'm not going to do it again. Okay, that's done. So when you go through my videos in IAS 7, there are 3 parts to IAS 7 you can go through, and there I've covered that group accounting part. So now let's start with business combination. What is a business? Business is something which is not an asset, of course. Yes, we all know that, right? When it's a business combination, that means you're purchasing a business. What should you do? You should consolidate. You should do consolidate. Okay, you just cannot consolidate anything. Whenever you're buying something, you have to see the property of that. Is it an asset or is it a business? Okay, how do you say it's a business? When an entity obtains a control over another entity, that constitutes a business. That time you have to consolidate. Okay, according to IFRS 3. IFRS 3 is business combinations. If the assets acquired are not a business, okay, they are just assets, they are not a business, then it is accounted as a purchase of an asset. And that asset could be dealt under any standard. If it's an intangible asset, IS 38. If it's a tangible asset, IS 16. So it depends on what type of asset it is, but it will be known as purchase of asset, not a business, and you don't consolidate for it. Okay, and most of the time, many questions have been asked on this area. If you see your past papers also, whether a transaction constitutes as an asset or a business. So you need this knowledge part from here. You need it to answer it. Now there are some common mistakes the students do when it comes to business. They think that some collection of resources makes it a business. No, business is not a collection of resources. Okay, example, a restaurant is more than just a building with ovens, tables and chairs, right? Restaurant also has chefs who are trained. Okay, they use this equipment they use in combination with the ingredients and their knowledge that they have, okay, to produce saleable finished goods. Okay, you cannot say a business is just a set of assets, that's it, ovens, tables and chairs, that's it. No, it's a process of many activity which are integrated together, which is dependent on one another, and they make an output. What is their output? You make good food and you sell it to the customer, right? So according to IFRS 3, a business must have processes that are able to convert acquired inputs into outputs. Business is more like a process. You have to do the process where you are converting inputs into outputs. Okay. Now let us go into the definition of what is this input, process and output. Input. Okay. Input are any economic resources. Example, it could be property, plant and equipment. It could be your intangible assets. It could be raw materials. It could be the employees you are having. These are your inputs. Okay, because through this you can create output. If you are using property, plant and equipment, you can make goods. If you are using your employees, having good employees, you can create good services, right? Because you definitely need employees to run the business. You cannot run the business without employees. So employees are also part of an input. They are known as input, even intangible assets. Okay, but they just do not make it into an output. Some processes has to be applied to that input. Some process they have to go through. They have to do these processes, the employees and all, to convert it into output. So what are these processes? Processes could be any system. That means they might have some system or a standard or a protocol. Okay, so when you are applying this to an input, you are creating an output. Okay, what is an output? Output is the result of the input and the processes that you have applied to the input. Output is like the final outcome that you are getting. It could be a good, it could be a service or income. That is known as an output. Okay, let us go to the concentration test. There is one thing that you need to do to see whether it's a business or an asset, which is known as concentration test. Okay, what is this concentration test? See, it's from case to case. It's hard to define a business, right? It is difficult because you have to use some judgment also to define a business. So what should you do? There you have to apply this concentration test. Okay, you are using this concentration test to see or to assess whether acquired set, whatever you have acquired, the acquired set of asset is not a business. Okay, you are seeing whether it's a business or not. Okay, the concentration test is met. The acquired assets are not a business. What is the meaning of concentration test? Is met. Concentration test is met when your acquired assets are not businesses. Okay, they are not businesses. They are assets only. What you have acquired is asset only, not a business. That means your concentration test has been met. That's what it means. Okay, if substantially all of the fair value of the total assets acquired is concentrated in a single identifiable asset or a group of similar identifiable assets. If you see, look at the fair value of the total assets that you have acquired. Let's say the fair value of the total assets you have acquired is 100 million. Out of 100 million, one asset is, let's say, 90 million. So you see a very high proportion, 90% of that fair value is concentrated on one single asset, which is 90 million. So it is an acquisition of an asset, not a business. You cannot consolidate because the word is substantially. All of the fair value. Okay. Is concentrated in a single asset. It could be asset, it could be a group of similar identifiable assets. Okay. Definitely we'll do some questions. We have questions. Don't worry about it to understand this better. Because I'm sure that by reading you will not understand what is this fair value, concentration, and all those things. We have test understanding 4 also, but we'll do all the test understanding at the end of this video. Elements of a business. What are the elements of a business? What if the concentration test is not met? Or you can say the test is not applied. What should you do then? If the concentration test is not met, you have to do more detailed assessment of the facts and the circumstances to ascertain if a business has been acquired or not. You have to go for more details, whether it's a business or not. Okay, remember, if you want to say that it's a business, it should have 3 things: input, process, output. All these 3 things has to be there. Okay. Whatever the processes that you have acquired, they must be important and they must be considerable also. Or IFRS says substantive. Not a small amount, no. It has to be a huge amount. Next. Outputs are not required for an acquisition of assets to constitute a business. You don't see what outputs you have acquired. Okay. Outputs are not required. You are not seeing the output. You're only seeing the input and the processes to decide whether it constitutes a business or not. Acquisition of asset constitutes a business or not. You don't need the output. Okay. Why is it? Because some early stage entities may have engaged in a significant research and development activities, but not as yet finished any projects or generated any revenue. That's why you don't go by the output. Because if you go by output, okay, what about those entities who are intensely involved in research and development activities and they have not yet finished their product? So they have the input, the process is also there, but they didn't yet finish the project. So output is not there. Okay. So because output is not there, they are not generating any revenue. That's the reason we don't look at output when we have to decide whether the acquisition of an asset constitutes a business or not. We are only looking at the input and the processes. If there are no outputs at the acquisition date, then an acquired process is only substantive if. So since we are not caring about output, forget about it. What about the process that we are acquiring? Process has to be substantive. And when is it substantive? When it is very critical to convert an input into an output. You need that. Without that process, you cannot convert that input into an output. And it's in bold. That means you need both. First, it has to be a critical process. Second, inputs acquired should include, for example, knowledge, skills, organized workforce. Okay, because if you are having knowledgeable workforce, you know that if they perform the process, they can convert the input into an output. So you need it. Okay, the process has to be critical, and the second thing is that you should have acquired this skilled or workforce or anything. If there are outputs at the acquisition date, then an acquired process is substantive if it is. Here, if there is no output, But here, if there are outputs, then what should you do at the acquisition date? Then the acquired process is substantive if it has these two things. What is it? It's critical to continuing to produce outputs. And the inputs acquired include an organized workforce with skills and knowledge to perform that process. So here also, it's very much similar to this one. But here, it's very more critical. It's much more critical than this one. Okay. Second, or. Okay, so this or that. They are more relaxed when it comes to when they have an output also at the acquisition date because it becomes easier for them. But if here, the first scenario, they are only relying on the process. That's why they have to see that that process has to be very critical. Okay. Second point, significantly contributes to the ability to continuing producing outputs and is either rare or not capable of easy replacement. Yes. It should be something which is rare and not something that you can easily replace that process. Then it is known as very substantive process. Okay. So we have some very good questions to decide whether this constitutes a business or not. Next, let us go to the acquisition accounting. I'm just going to touch the tip of this because the rest of this will be covered in the second part. Okay, which will be for the group accounting purpose, calculating NCI, fair value of goodwill, and purchase consideration, all those things. Acquisition method. What is the meaning of acquisition method? That means when you are consolidating. Okay, so you need this following requirements. Okay, I'm quickly going to go through this because this is from the exam's point of view. You don't have to write all those things. Okay, identify the acquirer. That means you should know who is the one who's acquiring. It's very easy. From the case study, they will tell you this one acquires this one. Determining the acquisition date. They will give you the date. Third, recognizing and measuring the subsidiaries' identifiable assets and liabilities. That means they are net assets. Okay, we'll be doing this. We definitely have to find the net asset. Then we have to recognize goodwill. Remember goodwill when we buy a subsidiary. It could be a goodwill or it could be a gain from bargain purchase. That means negative goodwill. Okay. And any NCI. If it's a subsidiary, then yes, NCI comes. But if it's a associate, then we don't recognize goodwill and no NCI comes. Okay. And most of them, this you are aware from your earlier studies. That means your financial reporting. So this thing should be very easy for you. Okay. But in SBR, you will be having very detailed knowledge on those areas is expected from you. Okay, very complex scenarios will be given and it will be detailed. Identifying the acquirer. Now they are going into detail for each one. So whoever is the one who has the control over another entity, that is considered to be the acquirer. Okay. And in business combination is very clear from the case study. Who is having that control? Lyra pays 1 million to obtain 60% of the ordinary shares of PEN. So who is having the control? It is the Lyra. Lyra is the acquiring company. But sometimes it is not clear that which entity has acquired the other entity. So in this case, what does IFRS 3 says? IFRS 3 says the acquirer is normally the entity that has transferred cash or other assets within the business combination. So whoever has transferred cash, given cash, or even other assets also to buy another asset, to buy another entity, that one is the acquirer, that entity. So you have to see the one who has transferred cash. Second, if the business combination is not involved the transfer of cash or other assets, then what? If not the first, then what? The acquirer is usually the entity that issues its equity interest. So you have to look for these words. If clearly you cannot, but most of the time, I have not seen any question where it's not clear. Okay, you rarely need these things. But let's suppose that in the case study, they don't say that this has purchased this one, then you have to look out for the entity who have transferred cash. If not, then the one who has issued his equity interest, they are taken as the acquirer. Okay. Some other factors are there to consider. What are those other factors? The acquirer is usually the entity whose former management dominates the combined entity. You see, former means before. The one who dominates the combined entity. Second, the acquirer is usually the entity whose owners have the largest proportion of the voting rights in the combined entity. For example, let's say they have told that 60% is bond in this entity. So whoever is having that 60% is the acquirer, and whoever is having the 40% is the NCI. And acquirer is normally the bigger entity. So all these things are quite easy. You don't have to memorize all these things. Acquisition date. The acquisition date is the date on which the acquirer obtains the control over the acquired. This will be given to you. Okay, and this will be the date at which, remember, this is the date when you calculate goodwill. The date when you have acquired a subsidiary, okay? That means you're having a control. And from which income and expenses of the acquirer will be consolidated. From this date onwards, the date when you have acquired, all the income and expenses, assets, liabilities of the acquiree will be consolidated. Okay? So from identifiable assets and liabilities onwards will be discussed in part 2. Now I'm going to cover all the questions that test your understanding. 4, 5, 6 and 7. To better understand what is a business. Test your understanding. 4. TACO. TACO purchases 100% of the shares in Fajita, a non-listed company. Fajita owns 20 houses, which are leased to tenants. The houses are located in the same area. The fair value of the consideration paid for the shares in Fajita is equal to the total fair value of the 20 houses. Okay. Apply the optional concentration test. Okay, the concentration test is optional. So apply this in IFRS 3 business combination to determine whether Fajita is not a business. Okay, remember that we apply concentration test not to decide whether it's a business, to decide to determine that it's not a business. Okay. So let's see the answer. The houses are a group of similar assets. And so the fair value of the total asset acquired in a concentrated in a group of similar assets. Right? Because if you see here, they told that the fair value of the consideration paid for the shares is equal to the total fair value of the 20 houses, right? So that means fair value of the total assets acquired means the fair value of the consideration only. To acquire that asset is concentrated in a group of similar assets, which is similar to as the fair value of the houses, 20 houses. What does this mean? This means that the purchase of Fajita's ordinary share does not constitute a business combination. Okay. So in substance, TACO is simply purchasing 20 houses. When the fair value is concentrated in group of assets or an individual asset, that means your consideration price, okay, if it is in one asset, if it is same as the amount of one asset or a group of similar assets, then it is not a business, it is you are acquiring an asset. Okay. Again, let me repeat this. Fair value of the total consideration paid, okay, is equal to the total fair value of the 20 houses. So they didn't say one house, so 20 it could be an individual asset like one house or a group of assets like 20 houses. But all those 20 houses are similar assets, right? So their fair value and the fair value of the consideration is same. That means it is concentrated. That fair value is concentrated in this 20 houses, which are similar assets. That's why this is not a business. This is an acquisition of an asset, which is 20 houses. Same rule you have to apply in all the other cases. Let us go to test understanding 5. Shepherd and Pie. Shepherd owns 100% of the shares in Pie, which is a non-listed company. Pie owns 10 houses, which are leased to residential tenants and to multi-store. So here is just not about 10 houses. Here they are now also having 2 multi-store office blocks which are leased to commercial tenant. Pie has no employees, with all property management tasks to be performed by other employees from within the Shepherd group. These are your processes they are giving you, okay? The tasks that property management should do. There are contracts in place for third parties to provide cleaning and security services to the commercial tenant. Total fair value of the house is similar to the total fair value of the office block. The directors of Shepherd wish to apply the optional concentration test to determine whether Pie is not a business. Same question, little bit more information. So this time, if you see, Pie's assets are all buildings and potentially the associated land. Okay, because to have house or to have office blocks you need land also. Without land you cannot just have houses. Okay, so potentially there could be land also in those buildings. However, the risk associated with operating residential properties are very different from those associated with operating office blocks. You have to find the differences in the risk or the return if there is more than one asset. Okay, one is for residential property, the other one we are using for commercial property or office blocks. So the risk is very different. So because the risk is very different, we can say the assets are dissimilar. Always you have to first find out whether the assets are similar or dissimilar. Then comes the next thing, the fair value. So in this case, earlier case, all were 20 houses, all were similar. This one, assets are dissimilar because the ones used for residential property, their risk is different to the ones we are using for the office block. So this means that the fair value of the asset acquired is not concentrated in a single group of asset, right? You have residential property also, you have office block also. Risk is different. It is so the fair value is not concentrated in one single group of asset. As such, Shepard must engage in more detail. So now because you cannot identify from here, okay, it is not proved that this is not a business. You have to go for more detailed assessment whether pie constitutes a business or not. Okay. Now we are going to the process and all those things, processes and input. So pie's assets produce outputs because there are leases in place that generate rental income. What are their output? Rental income. You will receive rental income and they are on leases. So because of that leases, you are going to get rental income. Those asset means that office block or residential property you are having, through that you will be having rental income. Rental income is your output. However, the purchase of pie does not constitute a business. Why? Because a substantive process has not been acquired. The process that you have acquired should be substantive for it to be a business. If it's not substantive, it's not a business. Like in this. This is because we have been told that there is no employee, so there is no organized workforce in place that can produce the output. Number one, because for it to be a business, you need substantive process, like you need organized workforce, employees, but here you don't have it. Next, what about the security and the cleaning services? Anyone can do them, right? You don't need a PhD degree to do this. They are relatively minor also and could be easily replaced. If you can easily replace a process and it's very minor, it is not a business. It is not a business. As such, the accusation of pie is in substance an asset accusation and not a business combination. Test understanding 6. Tani purchased 100% of Audacious capital of Kofta, an entity that does not yet generate revenue. Kofta operates in the biotech industry. That means heavily it will be involved in research and development. And also owns a headquarters, research laboratories, and technical equipment. Kofta employs senior management and highly skilled research scientists. So you can see that they have the input, but the output is not there because they are not yet generating revenue. Each of the Kofta's assets has a similar face value. Now, the optional concentration test is not met in this case. Why? Because the fair value of the total assets acquired is not concentrated in a single asset or a group of similar assets. It is not. Okay? Because here very clearly they have told, the last one, each of the Kofta's assets has a similar fair value. So it's not just one asset that has the majority of the fair value of the accusation. No. That's why it's not met. So if it's not met, you should go for more. Okay, Tani has purchased inputs. What are those inputs? Research and development are inputs. The tangible assets are input. The employees are inputs. It also appears to have purchased. Next, input is over, go to a process. It also appears to have purchased a substantive process. Why substantive process? Because experienced employees will have knowledge of the rules and conventions that are capable of turning the other acquired inputs, okay, in progress research and development activities and tangible equipment into finished marketable products. Because if you're having knowledgeable employees, they can easily turn whatever the goods and services that has not yet been produced, then the research and development phase, they can easily convert it into finished and marketable products. So because of this, the acquisition of corporate is a business combination, not an asset combination. Test understanding 7, identifying the acquirer. Okay. Abacus and Calculator are two public limited companies. The fair value of the net assets of these two companies are 160 million. 100 for Abacus, 60 for Calculator. 31st October 2001, Abacus incorporates a new company, Phone. In order to effect the combination of Abacus and Calculator, Phone issues its shares to the shareholders of Abacus and Calculator in return for the equity interest. After this, Phone is 60% owned by the former shareholders of Abacus and 40% owned by the former shareholders of Calculator. On the board of Phone are 4 of the former directors of Abacus and 2 of the former directors of Calculator. With regard to our business combination, discuss which company is the acquirer. So in your SBR, this type of question is very rare. I have not seen a question like this, to be honest. But let's do this to identify an acquirer. In case if you are given a question like this, you have to be prepared always for the most unexpected questions in SBR, okay? So if the business combination has not involved the transfer of cash or other assets, okay, because here they didn't transfer any cash or other assets, they didn't say anything about it, who is giving cash, who is transferring asset, what should they look for? The acquirer is then the entity that issues his equity interest. So here, who is issuing? It looks like the point will be the acquirer. Why? Because if you see one line, they told that Phone issues its shares to the shareholders of Abacus and Calculator. Right? If you go by that logic. Says Phone has issued shares in exchange for the shares of Abacus. However, other circumstances must be considered. What are those? Acquirer is usually the entity whose former management dominates the management of the combined entity. The second one is the acquirer is usually the entity whose owners retain or receive the largest proportion of the voting rights in the combined entity. And is normally the entity whose size is greater than the other entities. So all three of the circumstances points towards Abacus being the acquirer. Okay. So this would appear to reflect the substance of the transaction since Phone has been incorporated by Abacus and as a way of enabling a business combination with Calculator. Let's see now if you go through Abacus, okay? Because if you see, Phone is 60% owned by the former shareholders of Abacus. Former shareholders of Abacus, which is 60%. So if you see, it is larger than any of it. Okay? And if you are looking in terms of the size also, fair value of net asset of Abacus is 100 million. Okay? So it looks like that Abacus is the acquirer. But you don't have to concentrate so much on this type of question. Okay? It's not asked in SBR. SBR, they clearly give you who is the acquirer. So that's it for the first part. See you in the second part where we'll be talking about how to calculate fair value of net assets of the subsidiary, then the NCI, the goodwill, right? So see you in part 2 of IFRS 3.